one of the biggest advantage of GST, that is goods and service tax, is input tax credit. Now, before the introduction of GST, there were various taxes, different kind of taxes were there, like it may be central excise duty or it may be value added tax. All those taxes were there. Out of these taxes, in some taxes, the traders and the dealers as well as the persons who are registered under these particular taxes is to get back the amount of taxes what they paid on the inputs that they used to get back. Now that concept is derived from there, and we have implemented it under a concept called input tax credit. Input tax credit is a thing, that is, it is a benefit which is received by those registered persons under GST. That is, whatever you have paid at the time of purchasing the inputs, whatever tax you have paid, that tax you are getting back. So that tax credit what you get back is known as input tax credit. So what I can tell you is there are three types of taxes. So if we consider outward tax, input tax and net tax. Output tax is a tax which is collected at the time of sales. Input tax is a tax you paid to the persons from whom you have purchased the items or collected the items. And net tax is a difference. After the adjustment, what answer you will get is a net tax. So that is a thing what we have to consider here. Now we'll see what is the concept of input tax and we'll go further. Yes, let's see the concept of input tax credit with a example. So what it is, what input tax it is. Yeah, input tax credit means reducing your tax payable to the government on your outward outward supply for the input tax already paid on your inward supplies. So what it is told is input tax credit input tax credit means reducing your tax payable to the government. So what we are paying to the government on your outward supply. Outward supply means what we are going to sell to our customer. So when we are selling to the customers, we will collect the money and we will deposit it with the government. We will pay to the government. So now that money we are going to reduce. How? By considering the supply for the input tax which is already paid on inward supplies. So when you have purchased some items, that is what we will call it as inward supply, you have paid some tax, you will get some deduction on that. So that is what we will consider as input tax credit. That means output tax minus input tax is equal to net tax. So this is a concept, basic concept what we should know when we are understanding or when we are knowing the concept of input tax credit. So as I told, one example we are going to see. So as per this example, if my input tax is 350, andre when I purchase the item I have paid 350 rupees as tax amount, as GST, and my output tax is 425. That means I have sold some items to the customers and from them I have collected a tax amount, that is rupees that tax amount is rupees 425. Now in that case my net tax will be output tax. That means output tax is 425 minus 350. So 75 rupees tax what I have to pay to the government. So when I have purchased some items, I have paid an amount of rupees 350. Now I am selling the items and I am collecting the tax, that is rupees 425. Out of this 425, already I have paid 350 to the government. So that deduction I will get, and only 75 rupees I am going to pay to the government. So this is the concept of input tax credit. We'll see the three types of taxes. So 3 taxes, as I told: input tax, output tax and net tax. See, input tax will be paid on inward supply. As I told, when you purchase the items, you will pay the tax. Outward supply will be collected on output tax will be a tax which is collected on outward supply. That means our sales, when we are selling, we will charge tax from our customers, and that amount we are going to deposit with the government. Now that final amount what we are paying to the government is called as net tax. Now whatever I have paid to the customers, whatever I have paid to the person from whom I have purchased the item, that will be deducted from that amount which I'm supposed to deposit with the government. Yeah, so here for example 1000 rupees I have collected to deposit with the government. Out of that 500 already I have paid. So finally after the adjustment only 500 I am paying to the government. So that is a concept of input tax credit. We are going to solve the problems maybe in next class, next video. Now we'll see what and all persons who cannot claim input tax credit. Yarige this credit, when whatever you have purchased on that you will get what credit, that credit you are not getting. We'll see one by one. First one, exempt supply. See, exempt supply means those are a kind of supplies for which you have not paid tax and you are not paying any tax. So that's why there's no question of ITC at all. Now next, own or personal use. Some people will purchase the products for their personal use. You are a dealer, definitely you are a dealer, you are supposed to pay tax, but sometimes dealer will purchase some items for his personal use. In that case, that is not eligible for input tax credit. 2 points are over. Products for which ITC is not available, like government has notified some products for which there is no input tax credit. On such products you are not getting any input tax credit. Composite dealer. Composite dealer means the person who is registered himself under composition levy scheme. So those persons who are considering this, those persons are registered as composite dealer. They have registered under composition scheme. For them, input tax credit is not available. So about this we have studied already. Yes. So these are the concepts what we have to remember when it comes to claiming of input tax credit. Now, what are the conditions which should be fulfilled by a dealer to get input tax credit? These are the concepts we are supposed to see here. Now, we will see one by one quickly. First one, he has to file returns. Only those persons who are filing tax returns, then for that those persons it is available, input tax credit is available. Now, if you are not filing your returns, then you are not getting any input tax credit. Tax collected must be paid to the government. See, he will collect the tax and he is not paying it to the government, so then no deduction. So what he is going to pay to the government, on that basis this deduction adjustment will be done. Claim after full payment in case of installment. See, sometimes what happens is some products are purchased by the customers on installment basis. Now at what we know as EMIs. So in that case, after the full and final settlement itself, the action will be taken. Now no input tax credit will be allowed if you are allowing depreciation. So for on capital products, if you are levying depreciation, there is no input tax credit. So if you are paying tax before levying depreciation, before charging depreciation, then you may get input tax credit. Then tax invoices must. Bill of supply is not enough, tax invoices must. So if you are not preparing tax invoice and giving to the customer, you are not getting, there is no document, you are not getting the input tax credit. Last concept is receipt of goods. After receiving the goods itself, you can go for input tax credit. You have booked the product, deal is done, and you are doing the thing, claiming the credit, it is not possible. So these are the things we should know about input tax credit. Thank you.